What's going on, y'all? Happy Monday and welcome to another edition of Weeds Weekly, where we are going to cover this past week. And the Fed clearly reminded us that data is the most important thing. And then we're going to talk about this coming week where the consumer is back in focus. I'm going to touch on how many did you say? And what I'm going to talk about there is what my predictions are for the remainder of 2024 with regards to interest rates and how many cuts we're going to get. And then lastly, I want to just go over everything is negotiable. Look, different environments mean that we need to operate in a different fashion. So I want to remind us all out there, especially us agents and even us in the mortgage space, that everything is negotiable. So I want to touch on that real quick, right? With the objective of let's move some inventory. So let's just touch on this past week real quick. And we had a couple things. We had the Fed speak. We had Fed Chairman Powell give his semi-annual address to Congress. And the main messaging that he had were a couple things that people picked up on. Is number one, he is concerned of keeping the Fed funds rate a little bit too high where it's going to be a deterrent for the labor market. So that was a clear indication that they are getting ready to make a move. But the other thing that I thought was great, the Fed for once is really sticking to their guns and saying that, look, we're not going to be political. We're not going to be this. We're not going to be that. We are going to allow data to drive us. And if you recall, way back to the end of last year, they made it very clear that they are not going to do anything to that Fed funds rate until they get consecutive months. And what I think they mean by consecutive months, I mean 3. I think they're looking for those 3 consecutive months. I think I mentioned that last week. They're not going to do anything until they get them. And it was great to just get that messaging out of them. But it's interesting to hear that, right? They're prepping us. We're not going to get a cut in July, but September now is baked into a 95% rate cut. So that was last week. And we also saw last week on Friday, we saw CPI. CPI came a little bit right in at actually just slightly below forecast, indicating that inflation is moving from persistent back to still remaining to sticky, but it's moving in the right direction. It's digressing. And the main component of that, shelter inflation, is also pulling back. We're getting lower rents. We're seeing house prices actually at their peak and starting to come down a little bit across the country. And that's pushing that number down, which is a great thing. And the last thing it did for us last week is it pushed interest rates back to where we were in about March. We haven't seen the 10-year Treasury hovering around 4.2. I think for the remainder of this year, it's going to hover between maybe 4 and 4.35. It really just depends on data and what is going on there. But I think we're very comfortably moving in the direction now that the wind is at our back a little bit. We're getting a little bit of a tailwind, and we're moving from the 7s into the 6% range. So that was what I got out of last week, and I think that's great. So as we move into next week, right, or this week that we're in right now, if you recall, the first 2 weeks are the big data sets. So to me, the biggest things that we're going to be looking at this week is the consumer is back in focus. We got retail sales coming out, and the consumer for some time has been pulling back, and I expect much of the same, right? However, the big thing that I'm really concerned about and what I really want to see about that number and I'm interested in is what is the lag effect on the consumer? Even if the Fed starts to decrease the Fed funds rate, when is the consumer going to come back into play? Because if you recall, all the prices that have gone up, they're not going to go back to their pre-pandemic levels. We might get some deflation. We might get some of those prices and services to come back, but they're not going to go back to the pre-pandemic levels. People are going to have to adjust their budgets to accommodate for the inflation that now has been put in place over the past couple of years and is going to remain with us. So I'm really curious about what is that lag, and then when the Fed starts to decrease the Fed funds rate, what is the lag to get the consumer back up there? Because right now we were running at GDP, last we looked at it was 1.4%. That's not good. That's not good at all. And I expect that number to possibly get down to about 1.2%, which I think would be really bad. That would be slow economic growth. And then I'd be curious, does that roll over to the labor market? But I'm diving a little bit more. That's where my head starts to think. But this week, we're also going to learn, how bad is it? How bad is the real estate market? We got permits coming out, building permits, housing permits. It's going to get a clear indication of where is, once again, the builder at, right? The big tract builders, where is their headspace? We constantly hear in the news how housing and inventory is a major concern, but with higher interest rates being persistent for so long, right? due to that persistent inflation and the cost of goods still elevated, it's no wonder that permits are pulling back. But it'll be interesting to see now that it looks like interest rates are starting to come down a little bit. Are they ready to jump back in already? Is it a quick turn for them? Or is there a slight lag where we're going to see it kind of over the summer, coming in the fall? They're going to need to see a little bit more data, a little bit more security, a little bit more activity by the consumer in order to pick those building permits back up. So that'll be really interesting to watch. But that number is big this week as well. And then we have a lot of Fed people speaking this week, a lot of Fed members. And look, for a while there, I'll acknowledge, listening to the Fed was like a broken record. It was the same message over and over. But as we're now getting to the point where the tide is turning, there's a 95% chance that the Fed is going to reduce the Fed funds rate in their mid-September meeting, right? Because they're going to have 2 more data sets to look at. They're going to get next month of August, and then they're going to get the beginning of September. That will be their 3 consecutive months. And I think there's just a lot of comfort that we are moving in that direction. And the Fed, like I said, has already said they do not want to keep interest rates or the Fed funds rate elevated too long so that it is a major deterrent towards the labor market. So you can book a September one. But what are they saying now? Are they going to play their hand a little bit to give us an idea with the election coming? And then we have a November and a December policy meeting. What do they anticipate? So everyone's going to be hanging on their every word for that because the market's always forward thinking. So it's a great thing. It's a great introduction to how many did you say? And you know, what's so funny is probably in the last month, right? We expected 3 Fed fund rate cuts by the end of this year. At the last fund meeting, the Fed came out with their dot plot, right? And indicated that we're going to get 1. We're only going to get 1 more. That's all they kind of can forecast for the remainder of this year. And everyone was like, is it going to be before the election, after the election, so on and so forth. To now, we are back into where everyone is saying we're now going to get 2 or 3. 1 is basically guaranteed at September. And you have everyone from CEOs to economists to traders to politicians screaming from the top of rooftops that we need to get cuts going because they are forecasting, or they obviously want to say, hey, everything's picking up, everything looks great. And everyone wants to get that feel good about the economy, but that's not the Fed's job, right? The Fed has got to be relying on data, and that's what's going to drive it. But I find it very interesting in this last 4 to 6 weeks, we've gone from 3 to 1. Now we're back to 2 or 3. So what do I think? Here's what I think. I think the Fed is never going to get to their 2%. I think it's pie in the sky thought that they're going to get to a 2% inflationary rate, and that's where they think that they're going to land the plane. I think that's going to be adjusted. I think they're going to have to get accustomed to 2.25%, maybe 2.5%. They're not going to get that to that 2%. I think inflation is going to remain a little bit sticky here as we kind of move through the summer. I think that the labor market is going to continue to pull back, possibly another 10%. I don't think it's going to fall off. And I think the consumer is going to pull way back. So what do I think? I think that September we do get that cut. But let's be honest. The market has already baked that in, right? The market is already there. So that's why we're in the 6% range. So I wouldn't get all crazy and telling my clients that we're going to be in the low 6s, high 5s, and so on and so forth. We made that mistake. Everyone that was preaching that last year has already been proven wrong this year. So let's not make that mistake again. That Fed funds rate cut is already baked in. And what do I think? I think the Fed pauses in November. You got the election on the 5th. Their meeting for the Fed funds policies on the 6th and 7th. I think what the Fed's going to do at that point is they're going to see the numbers. They'll be really stable, like I said, around that 2.5% on inflation. I think the labor market will continue to tick down ever so slightly, but it's not going to fall off. And I think the consumer keeps pulling back. So that is going to be a major concern of the Fed's. But I think those other data points outweigh consumer spending right now. And I think what the Fed is going to do is they're going to pause in November. They're going to allow the election to actually settle in to see if the consumer behavior changes as we move into the holiday season, it absolutely, positively, definitely speeds up and picks up. And I think the Fed will rely on that. And then I think we get an additional rate cut in December. So what I think is going to happen is we're going to basically lay out in the 6% range, anywhere from, depending on your credit, the high sixes to the low sixes. Over this past week, I've been quoting rates as low as 6% on an FHA, depending on your loan amount. And I've been quoting rates as low as 6.25% on conforming, depending on your loan amount and your credit score. So we're already there. And I think we get by the end of the year to possibly the high fives. So that is great news. And then moving into 2025, I think we can anticipate another rate cut in Q1. And then I think we're going to be hovering in the low sixes to the mid fives for the first half of 2025. So I think that's the great news. So that's my predictions. That's where I think it's going to go. And hey, I thought that we were going to get our first rate cut in July. So I'm only off by one Fed funds meeting because we're going to get it in September. So we were close. We were close. And then the last thing I wanted to touch on is that everything is negotiable. You know, I've been doing a lot of property tours and they've been great. I love them. I love going on them. I love meeting some great agents. I love learning from them. I think there's some really knowledgeable people out there that have been in this industry a long time. And then I love looking at houses. I love seeing different neighborhoods. I love seeing, styles that people have. And it doesn't matter, the price range or anything like that. I just love the industry. So I really enjoy it. But obviously the one thing that we go out, the main message is, hey, it is a slow market. There's hardly anybody coming to open houses. I haven't had a showing in weeks, or I'm getting one a week. So the objective is really how to move this inventory. And, for a lot of people in Austin, Texas, agents have never seen this. I don't even care if you've been around. I think it's been at least, 15 years plus? I mean, correct me if I'm wrong, but off the top of my head, I'm guessing Austin has not seen a market like this in at least 15 years, possibly 20 plus. So a majority of your agents, 90%, 80% at least, have never been in this environment. So I thought it'd be good to let's refresh that in this type of environment, because I've been through it numerous times. Being a real estate broker up in Michigan, I have seen this play out several times. And the main thing that you need to remember is that things during that time are negotiable. We get so steadfast in, no, that's not negotiable, or this is how I did it before. Hey, it's gloves off now. It's game. It's all things are in play. So I wanted to touch on a few things that I'm hoping might potentially help. Number one is your sales price, right? You have to remind your seller that everything is negotiable. The market will dictate what it is. And the biggest thing I like to do with my clients, especially in this environment, is have a timeline and a game plan. At this date, if we don't have this type of activity, we are going to do this type of reduction. We are going to do this type of reduction. What is your bottom line? What if you get this offer? You play through all those scenarios now on the front end, so you're not dealing with the emotional roller coaster on the backside. You've addressed it. It's already in their head, right? I think that is a great approach, especially in this environment. You need to get your seller's mindset around it. Everything is negotiable with an offer that comes. Number two, seller concessions, right? Getting both the buyer and seller. I'm telling everybody, every agent that I run into, I would be writing every offer right now with seller concessions attached. Unless it just came on market, if it's been there for 2 weeks and they don't have an offer, I'm writing something with seller concessions. It is something that can be negotiated. You can ask for 3%, maybe you get 1%, maybe you be elated with 1%, your buyer would be. But again, it's a negotiation tactic to go in and get the ball rolling. And who knows what you're going to get from the buy side that's going to be able to help your client. They're going to feel warm and fuzzy about it. And on the seller side, they should already be prepped knowing that offers are going to be coming with seller concessions. So how are we going to handle them? Again, what's our bottom line? What if we get in one with 3%? What if we get one with 2%? And so on and so forth. Cover that on the front end. The second thing, my third thing was title fees. Look, I'm not saying that the title fees can be changed. What I'm saying is it can be negotiable of who pays for them, right? Depending on where you are, there's already kind of a set playing field for, hey, buyer pays for this, seller pays for this. But instead of seller concessions, you as a seller might say, I'm not going to give seller concessions, but I'll pay all title fees. I'll pay your title fees. As a buyer, you might be writing an offer and you might ask for the seller to pay the title fees. Again, understanding that everything is negotiable and educating both your buyer and seller on the front end that these are possibilities. These are things that we can ask for. These are things that we negotiate, right? Everything is in play in this type of market where you have almost 5 months of inventory. I'm telling you, if you get this mindset, knowing this, your clients not only are going to appreciate it, but you're going to move more inventory. The fourth thing, and nobody likes to hear it, well, actually that was 5. Fourth thing is commissions. And I'm not saying you go in talking about reduced commissions because I don't think that's the smart tactic. But at the end of the day, we need to move properties. You need to move properties. Everyone is going to be giving a little potentially. There's always going to be people, where you want to create a win-win. And we may just have to dip in and give a little to get a deal done. So again, know your numbers as well. Know where your mindset is, that if an offer comes in, would you say to another agent, hey, let's bring this commission down to 5%. I'll split it with you. Those type of things, right? Don't wait for that to come to play. Know going in, have a strategy and get your mind around the fact that you may have to take a little bit less to make a deal go through so it doesn't become emotional. And then lastly, throw myself under the bus. Mortgage rates and fees are totally negotiable. There's no doubt about it that they are absolutely something that you should be encouraging your client to shop for. Not only the fees of what us as mortgage professionals charge, but what are our rates, right? And educating your clients on how to shop. There's basically only 4 questions, and I'll cover that next week. What are the 4 main questions that a person that's shopping for a mortgage should be asking in order to shop so that they can compare? Because it can get really confusing with a loan estimate and looking at all the fees and title and all this and all that. There's only basically a few things that we as mortgage professionals can control. And those are the exact questions that buyers and people that are looking to lock down a loan should be asking people in my position. All right, I hope that helps. I hope you enjoyed this week. There was a lot to read, so if you're reading it, hey, God bless you, because it's a lot. But I got a lot upstairs. Have a great week. You need anything, you got clients that need something, please don't hesitate to give me a call. You need me to run a scenario. I've been running a lot of buy down scenarios for clients. I've been running a lot of just what is going to be monthly payments for clients and for real estate agents. So lean on me as much as possible. I'm around. Just pick up the phone, give me a call or shoot me a text or whatever you need to do. Shoot me an email. Have a great week selling out there and cheers.